All right, today we're going to break down the wild story behind the crash of Constellation Energy. Now, this was a stock that was absolutely flying, riding that AI hype train, and then it just completely fell off a cliff. So we're going to dig into exactly what happened, why it happened, and what it tells us about the future of energy investing.
And really, it all boils down to this one question, right? What happens when an investment that everybody thinks is a complete sure thing suddenly and violently proves everybody wrong? Okay, let's set the scene. We're talking about Constellation Energy, ticker symbol CEG. For months, this company was just the darling of Wall Street, a real high flyer that honestly seemed to have the perfect story for where the world is heading. And this story that got investors so hyped up, well, it was a killer story. Constellation is the biggest producer of carbon-free power in the US, mainly because they have this huge fleet of nuclear power plants. So you've got the AI revolution needing insane amounts of electricity. Our power grid is already stretched thin, and investors saw a super simple equation. Tons of demand plus not enough supply equals huge profits for CEG. It made so much sense that everyone, from the big hedge funds down to everyday traders, was just piling in. But, and this is a huge but, here's the catch. The stock shot up so far, so fast, that all that good news, all of that incredible future potential, was already baked into the price. This created a really fragile, really dangerous situation. The stock was basically priced for absolute perfection, which meant there was zero room for anything to go wrong. So when the stock did crash, the first thing everyone did was to look at the usual suspects, you know? It's like you're a detective showing up to a crime scene. You've got to rule out the obvious stuff first. So first thing you check, right? Did the company's business just fall apart? Were the earnings terrible? And the answer was a clear no. The crash wasn't triggered by bad numbers. The business was doing just fine. Okay, so what about some kind of scandal? You know, did the executives know something was wrong and start dumping all their stock? Again, nope. We looked, and there were no signs of major insider selling, no whispers of some big internal problem that would spook the market. All right, last one of the usual suspects. Maybe an operational issue? Did one of their nuclear plants have a problem or something? And again, the answer was no. The company's most important assets, their nuclear fleet, were all humming along perfectly. The actual business was solid. So this is the real mystery, isn't it? If the company was making money, the leadership wasn't shady, and the operations were fine, what in the world could cause a stock to just collapse like that? Well, it turns out the answer wasn't inside the company at all. The problem came from the outside. It was a regulatory smoking gun, a hidden risk that a lot of people were either forgetting about or just flat out ignoring. To get this, you have to understand a group called PJM Interconnection. The easiest way to think about them is like they're the air traffic controller for the power grid, but for a huge chunk of the US, from the Mid-Atlantic to the Midwest. They manage the flow of all that electricity. And, this is the crucial part, they set the rules and the prices. So here's where it all went wrong. You had what investors hoped would happen crashing right into what was actually happening. The bull thesis, the whole reason people own the stock, was based on the idea of sky-high, uncapped electricity prices. But the reality, regulators, feeling the political heat from people's rising power bills, just stepped in and said, nope, we're putting temporary caps on those prices. The market stream slammed headfirst into political reality. And this is so important to understand. The crash had nothing to do with the money Constellation was making today. It was about the future. That one announcement forced every investor to completely rethink what the company's profits could look like for years to come. It was like the market slammed on the brakes and said, wait a minute, that entire future we priced in, it's not going to happen that way. The entire story got repriced, violently, in just a few days. Now that PJM news, that was the spark that lit the fuse. But it wasn't the only thing going on. There were a couple of other factors at play that were like throwing gasoline on the fire, turning a bad situation into an absolute catastrophe. There were really three key accomplices here. First, as we already said, the stock's valuation was just way up in the stratosphere. Then, on top of that, the company announced it was about to take on a whole lot of new debt. And third, there was this lingering uncertainty around a huge acquisition they were trying to pull off. And look, we're not talking about a little bit of debt here. Constellation announced it was issuing billions of dollars in new notes. Now think about that timing. Taking on a mountain of new debt right at the exact moment your entire future profit picture gets called into question, that is a combination that makes investors really, really nervous. And then, on top of all that, there is the company's pending deal to buy another energy producer, Calpine. Now, huge mergers like this are always tricky, and when the market is already panicking, the last thing investors want to see is more risk. They started worrying about the strain on the company's finances and all the things that could go wrong with putting two giant companies together.
So, after we piece it all together, what's the big lesson here? What does this whole disaster teach us about investing in a space like energy from now on?
The number one lesson, without a doubt, is this. When you're dealing with a highly regulated industry like electricity, a single announcement from a regulator can completely crush a company's great performance. Politics and policy can be just as important, and sometimes even more important, than the actual fundamentals. Now, it's really important to say that the big picture story here is still totally true. The world's need for electricity, especially with AI and electric vehicles, is real and it's growing. And clean, reliable baseload power from nuclear plants is absolutely essential to making that happen. That hasn't changed.
But here is the critical shift in thinking. What has changed is the market's expectation of who actually gets to pocket the profits from all that demand. We now know that just because demand is off the charts, it doesn't automatically mean the power companies get to keep all the money. Regulators can, and they will, step in to keep costs down for consumers, and that puts a ceiling on the upside for investors. So what happens to the stock now? Well, you can kind of see three possible paths forward. In the bull case, these price caps are just temporary, the AI story plays out, and the stock recovers. The base case is that power prices stay kind of moderated by these policies, and the stock just trades in a stable range. And then there's the bear case. The regulators keep a heavy hand on the market, and the stock's valuation gets squeezed even more.
And all of this leaves us with one final, really big question that this whole story boils down to. As we build out this new electric future, who holds the real power? Is it the free market with supply and demand? Or is it the guiding and sometimes very heavy hand of the regulator? That right there, that's the billion-dollar question.